Hey everybody, it's André Beganski coming to you with an interview today with none other than Prometheum founder and co-CEO Aaron Kaplan. How are you doing?
Good, Andre. How are you today?
Good. I'm excited to take tokenization, regulatory trends, and all things crypto. I think, you're not one of the most familiar faces in crypto, but people definitely remember you from your SEC testimony during the Gary Gensler era. Back then, Gary Gensler upheld Prometheum as an example of a firm trying to comply with securities laws while building towards an innovative service. At that point, some people did criticize the firm and compare it to a bicycle with no wheels because of a lack of supportive assets that, in theory, would need to be registered with the SEC. Years later, has anything changed? And what does the firm actually do today?
Things have changed in the context of we're seeing a larger melding between the crypto industry and the securities industry, whether that's the integration of distributed architectures or blockchain technology into market infrastructure on the regulated side, or whether it's the potential introduction of certain concepts that have been incubated in sort of the crypto space into securities. And I think that's a good point of discussion in tokenization. But in context with the firm, we basically are we service the entire life cycle of a digital asset. We have a transfer agent, a introducing broker dealer, basically an alternative trading system, and a special purpose broker dealer, which is our custodian. And we service basically securities on chain. So as this industry has grown, we continue to grow with it.
In terms of the securities that you guys are trading, could you just give people like a quick synopsis of what that actually looks like?
Sure. So we're supporting custody with 5 tokens, I think, 4 or 5 tokens, and adding to that all the time. And we've been working with issuers to issue on-chain securities with more, I guess you would say, the modernization of traditional securities by moving them from electronic markets to on-chain.
I think blockchain security became like a very loaded term under the Gensler era, obviously, because of people's criticisms or concerns with the lack of clarity between what constitutes a commodity versus a security. But I think the term blockchain security actually does have a new flavor in 2025, a little bit in 2024, and that's tokenization. I mean, Prometheum on its website still describes itself as a business that deals in blockchain securities, but you guys are clearly pushing in the realm of tokenization with some of your recent acquisitions that I'll get into later. What's with the pivot?
It's not really a pivot. It's basically like when you think about securities on chain, right? There's 2 different components to it. There's securities that are issued natively on a blockchain, meaning the actual issuance is issued via cryptographic tokens. And I think that's really more of a progress in sort of the modernization of markets, because it actually allows the entities involved, meaning the issuers, the investors, to take advantage of securities that are issued, that trade, and that are custodied, that are all blockchain enabled. So then they could be used in sort of like the decentralized markets, right? And the question is sort of how do you allow for an asset to take advantage of the concepts that have been incubated in the DeFi space in a manner that still allows investors to be protected? And I think that's what happens with on-chain securities, because the securities actually natively on-chain, right? And the ownership moves with the movement on-chain. And therefore, it actually is a real representation of the asset. Whereas once you move to more of the tokenization side, there's a lot more complications that could be introduced there. And I think we might get into a little bit more later.
Sure. Yeah. No, when it comes to the idea of tokenization, you're seeing tokenization used as a buzzword. You're seeing tokenization used as a product label. You're seeing tokenization used as a way to sort of justify new business models. And when we talk about tokenization, you very, very explicitly put native before that. And, curious about like what you think is so unique or so important about native tokenization. I know you got into it a little bit just there. And, like how you've seen like the term evolve over time, because it does feel like people use different definitions when talking about this.
Yeah, and I think that the definitions are super important because it leads to a lot of confusion. So from at least our interactions with regulators, and I think this is in general how it's understood, is that tokenization is a cryptographic representation of an asset that's off-chain, right? So it's basically issued in the electronic markets, the digital markets, and in an attempt to take advantage of being blockchain native, meaning the instantaneous settlement, the ability in theory to be used off chain, in a decentralized sense, right? There has been sort of the idea of taking, let's say, equities, an existing equity that's been executed in the electronic markets, and creating a tokenized representation of that such that it can be traded with instantaneous settlement, et cetera, right? And the problem is that I think people have started to view tokenization as an alternative to regulation, as maybe a sort of a pathway towards, in theory, compliance with a smaller regulatory burden. But like really, as we saw with Commissioner Peirce's statement, I think it was on July 9th, right? Tokenization is just a representation of a security. It might be a derivative, but it's a security. And therefore it still has to follow the rules, right? So essentially it needs to be done in a securities licensed infrastructure, sort of like what Prometheum has created, where you have the ability to, trade, clear, settle, and custody that, right? Through its subsidiaries, Prometheum Capital, Prometheum ATS. Sorry, I have to say that from a regulatory perspective. But like one of the issues that we've seen with what's happening with tokenization now is like people are talking about using it from a lot of different angles. So we talk about like a tokenization of funds, right? That's one angle. There's also tokenization of existing equities, which we've seen occur primarily outside the United States, with major platforms trying to sort of take maybe do a proof of concept and get some sort of eventual established product such that they might have a better chance of introducing it into the United States. But like from those perspectives, like the question is, what additional risks are being introduced to investors who are participating in that? And I think that's sort of where the rub is here, because like when you're tokenizing a product one for one, right, that could work. So you have one equity underlying, you have one tokenized representation of that. Theory, no problem. But when you start to have sort of synthetic tokenization, or let's say a 5-to-1 or 100-1, where it's 100 tokens that when you only have one underlying, you have a dislocation between the actual trading that's occurring and the underlying. So then it becomes a question of like, what are your rights there? If I'm trading a tokenized OpenAI share, but there's not an underlying representation one for one, really you're trading some sort of synthetic product, right? Because there's not the actual underlying, and it leads to potentially much greater risk. So it's just a question of, how that needs to be viewed, whether it's a buyer beware situation, whether even the people who are participating with that, the retail traders who are trading that, even understand the fact that they don't really hold the underlying. They don't own the underlying.
You talk about OpenAI shares, and right, that's stock tokens from Robinhood, one of the recently unveiled products that we've seen in the tokenization space. And I think you saw OpenAI come out and say like, hey, we're not associated with this. This isn't actually stock. And, Robinhood did address some of that confusion. I think one of the things that you just sort of mentioned there that I think is worth unpacking is like the potential risk factors here that could be introduced into the market through tokenization if not done properly. What do you see going on, and how do you think it could go ugly?
So there's multiple different factors and risks that are introduced. First is like when an issuer issues securities and they're not public, they haven't chosen to make them public, right? And historically it's been up to the issuer to determine, them and what's at the best for the best sake of their investors, whether they should go public and have some sort of liquidity, public trading, right? And when you create a synthetic trading away from these private shares, right, the actual ownership of these private shares, you can make an argument that like you're taking the actual integrity of the asset and like the full faith and credit of the issuer and sort of abstracting that to the platform that's issuing the synthetic token. So then it becomes a question of, okay, the investors on this platform, they think they own this, right? But if there's no underlying representing the trading, and let's say the investor believes that they can call that, right? They actually can take ownership. The platform that's issuing these synthetic tokens is essentially writing naked calls. And from an options standpoint, like if anyone who follows options knows that like naked call writing is an inherently risky activity because the losses are unlimited, because the stock could go to $1 billion, right? Obviously that's absurd, And the platform would have to cover that. They'd have to go buy that in the market and then deliver it to the investor, right? Now, that introduces a certain element of risk. And then the other thing is a ownership of equity. When you own equity, you have the right to dividends. You have the right of a shareholder. You have the right to vote. Like, I don't think, I don't know, and I don't really think you have that with a synthetic token.
With some of the derivative products that we've seen, I know for a fact that like these tokenized stock products from Robinhood do not have the same ownership rights, do not have the same entitlement to voting or dividends that you do see with traditional stocks. And I think that's what you're getting at, which is this idea that like if you natively tokenize an asset, you would actually have those sort of same entitlements.
And then the question is like, what's the goal here, right? Outside the United States is different than in the United States, right? To be done in the United States, Commissioner Peirce, she's known as the crypto mom, right? And basically, like just being a little bit tongue in cheek, like mommy has told you this is not allowed, right? She's basically explaining that like this is potentially problematic here, right? And from that standpoint, like if the platform is looking to do that in the United States, they'd have to do it through a securities market infrastructure because it's a security, right, or a derivative security, right? And B, like becomes a larger, almost philosophical question, like what's investing versus what's gambling? Investing is understanding, hopefully based on fundamentals of a company or even a cryptocurrency, right? If you look at, let's say, Ethereum, right? Investors would notice the activity on the blockchain, the supply and demand, the tokenomics, right? But when you're creating these synthetic products that don't have any right to the underlying, what you're really doing is like you're taking away the integrity of investing and you're moving much more towards a gambling mindset. So like the question then is like, if we look at what's happened in the industry and like where there's been a lot of activity, like, is this the meme coinification of equities? Right. And not just that, like even to take it a step further, and this is a little bit like maybe excessive, but if you don't have the underlying, right? Are we not creating the algorithmic stablecoin of equities? Right? Is this not the Luna Terra?
That's one way to definitely look at it. When you were talking about that, I did get a little bit of my 2022 flashbacks. And, there's another flashback that I actually want to bring up because, we have Hester Peirce coming out here sort of blowing the whistle to an extent on some of the activity that we're seeing with tokenization. But this isn't the first time the SEC has gone and taken an enforcement action against somebody that's offered tokenized stock trading. You've been around the space for a while. Abra, back during the pandemic era, Binance, FTX, these companies dabbled in tokenized stocks. Abra actually got hit with an enforcement action for it. Like, how do you view what companies are doing today compared to what Abra got in trouble for back then?
So first off, in regards to what's occurring today, it's happening outside the United States.
Yeah.
And I think if U.S. investors aren't touching it, it makes it, in theory, not as dangerous. It makes it dangerous for those investors, but not dangerous from a regulatory standpoint in the United States. I think, and I'm trying to remember the exact specifics of the Abra case, but in that regard, even if you're doing a 1-for-1 tokenization, meaning you have one equity underlying each token you're creating, right? It's a security. It's a derivative security.
It's a derivative of a security. Yeah.
And you need to have it on a securities market infrastructure.
Mm-hmm.
So like whenever, like previously the idea of like being a bicycle with no wheels, these products are all securities in that capacity and they need a market infrastructure for it. So there's a lot of energy around tokenization. Right? We're seeing certain things occur outside the United States, but for it to occur in the United States, it needs to occur on an infrastructure like what Prometheum has created that has the licenses to conduct these activities.
Yeah, and I think honestly, I know this is super basic, Aaron, but like when it comes to disintermediation, I don't think that's a word that you hear a lot in the crypto space. And it's very core to what like Prometheum is actually trying to do. You guys have been around since 2017. You guys recently raised $20 million. Talk to me about like what hoops you guys have had to jump through and like what licenses you guys have had to attain and what steps you guys have had to take to break the business as much as possible in order to comply with this idea of disintermediation.
Disintermediation in the context of like traditional securities market infrastructure is more along the lines of eliminating certain elements of a life cycle of an asset that are costly and that are just part of a legacy infrastructure that exists. Because if you look at the securities space, since markets went electronic in, like, say, the 80s, right, or the 90s, right, you have layer of a technology built on top of each other, and it becomes more rigid and more expensive as each layer is added, right? So our whole concept was to integrate blockchain technology into market infrastructure to just create a better apple cart, meaning you're following the same rules, but basically you're eliminating the drag that occurs from legacy systems, whether that's on the transfer agent side, whether that's on DTCC, whether that's just in sort of the operational needs that occur on a life cycle of an asset, particularly when it comes to reconciliation on the clearance side, right? That in theory, if you could knock off 30% of the cost, 40%, maybe even higher, right? You've created an ecosystem which is just doing the same thing, but integrates the benefits of blockchain technology, meaning the record keeping, the ability to issue cryptographically, et cetera, the instantaneous settlement. And I think that's why it's attractive for the securities industry as they're looking to move from electronic to digital, right? And like, as that's occurring, right, it just, like, why did markets change from paper trading to electronic? It was two reasons, right? Paper trading back in the day, there used to be so many broken trades that they'd have to take stock market holidays. Like, it'd be like, we're off next Friday. And we're not actually off. We're just fixing all the broken trades because there's so many trades occurring, right? And they need to be reconciled or else the market's going to break down, right? And essentially, by like, the reason it went electronic is because it just saved people time, money, effort. The same thing applies here when you're doing it with sort of integrating blockchain technology into market infrastructure. And if we look at what Chairman Atkins has been saying, right, he's talking about really modernizing market infrastructure. I think the way he's referring to it, I'm pretty sure, is by modernizing market infrastructure by marrying the benefits of blockchain technology and the federal securities laws into market infrastructure. And that's what we've been focused on all along. So maybe we were a little ahead in terms of where we thought things were going. Right? You know, at the time, there was a lot of questions on how crypto would be treated, right? That's not really as relevant right now because the entire securities industry is moving on chain just because it's a better sort of operating system, right? And the entire securities industry is, I think it's $130 trillion in the United States.
Yeah, and I think you've sort of laid out before that, like, that ultimately is the holy grail. It's not the idea of sort of like growing the digital assets industry, but as you said, like sort of capturing that addressable market within traditional sort of spaces. You know, one of the things in May, you guys acquired a broker dealer and launched a digital transfer agent registered with the SEC. What does that enable Prometheum to do that it couldn't necessarily before?
If you think about it, like, what the transfer agent has become in terms of the modern context is a tokenization agent, meaning it's where the minting and the burning of the asset occurs. So historically, the transfer agent was the record of ownership. Basically, if you think about it, like, market infrastructure had all these different participants, from the transfer agent to the introducing broker dealer to the clearing firm, to the market, to the exchanges, to the DTCC, to all these different components, right? And all their information siloed, right? And the question is, how do you reconcile it all? Well, the official record of ownership was at the transfer agent, right? Now, when you have actually securities on chain, the record of ownership, as everyone knows, is the blockchain, right? So what is the point of the transfer agent? The transfer agent that becomes a tokenization agent, meaning where the actual asset is issued and meaning minted, or burned, meaning, you know, burned from a cryptographic sense, right? So that's really important as securities move on chain, or different, whether it's money markets or different products moving on chain, you have to have the ability to create and destroy the asset, right? That's one component there from the transfer agent. Now, from the introducing broker dealer is where capital formation occurs, right? So basically, when you do a offering and you want to raise for a product, that is where you will actually be able to take in the investment, such that then when the asset and the product's distributed, right, the actual minting occurs. That's when that's how that will occur, right? So basically, you have the ability to create, mint and burn the token, and actually do the initial funding for the products through the introducing broker dealer there and the transfer agent respectively, or the tokenization agent. So that's really important because it meets the other parts of our ecosystem, right? Because if you think about it, you need to be able to create an asset, you need to be able to distribute it through an introducing broker dealer. And then what happens once it's distributed? Well, that's been part of the problem with what's happened historically with tokenization, because where does it go from there? There's few, if any, ATSs that are publicly trading these assets, right? And you're not trying to create new assets on chain that are illiquid, right? Other words, that could be done electronically, that could be done even in paper. It's irrelevant, right? They need to have liquidity for that industry to grow. And that's what we have next, which is our alternative trading system. Now, an alternative trading system, right? There's different types, there's different things I could do. We could do digital asset securities, right? But essentially, that's the public market trading venue, right? The actual, what you would call in the traditional, it's not an exchange from a legal technical standpoint, because that's a term of art, right? You can't call yourself an exchange unless you're NASDAQ or, New York Stock Exchange, et cetera, right? But in order to have public trading, meaning not just like illiquid, like private share market trading, you have to be able to do the clearance, settlement, and custody. And that's the last part of our ecosystem, and that's our custodian, our special purpose broker dealer. So that's the entire life cycle of a security on chain. And that's why it was really important in terms of like the acquisitions and sort of what we've been doing, because it shows the development as our ecosystem moves along. Because the whole point was to create a alternative market infrastructure that meets really what Chairman Atkin's talking about, that's modernized by marrying blockchain technology and the federal securities laws.
Just for the context that, like, so people have it, like, how much trading does Prometheum's platform actually facilitate these days? And what is like the sort of amount of assets under custody look like for you guys?
Yeah, we haven't really been disclosing publicly any of that, but essentially like the assets under custody continues to grow. It just becomes a question of sort of the activities. And I'm not sure, and I'm sorry if I'm jumping the gun here, in regards to the recent announcement, which was correspondent clearing at Prometheum Capital. And that really is super important because it allows us to utilize our custodian, not just for ourselves, but for the entire brokerage industry.
Got it.
Right. So like one of the things that was really important there is that like I think, and this is a little bit ancillary, but I think it's important to the context here, is like when we look at the history of like what's happened in the space, like there was all this talk about how like regulatory clarity really hurt the crypto space, or lack of regulatory clarity, right? And I get that argument, but I can make an argument too that a lack of regulatory clarity actually allowed the crypto industry to grow at the sake of the brokerage industry. Because like all the brokerage industry had the accounts, they had basically the investors, they had the assets under management, but they weren't allowed to do crypto products, right? And so essentially people would take their money from the brokerage industry, move to the big crypto exchanges, right? Which weren't held to the same standards in terms of like, or had different regulatory standards, basically approached it differently, right? And it basically was a major disadvantage to the brokerage industry, right? But with the introduction of correspondent clearing and basically having the right to do that now, the brokerage industry could arguably compete fairly now, once again, with the crypto industry. And now it's not basically, oh, like we can't do these services. We can't basically allow you to do this. You're going to have to take your money out of our system and put it on the crypto system, right? In the crypto universe. Now these worlds are, as I said before, they're melding together. And correspondent clearing is a clear sign of that, and will allow the brokerage industry to now offer their customers access to digital assets, which is a massive step forward.
Yeah, but digital assets that are classified as securities, right?
Digital assets, meaning assets that are both securities on chain and arguably crypto.
Yeah. Well, I know that you guys at some point were planning on custodying Ethereum. I believe like you guys do custody Ethereum. What do you make of Ethereum's regulatory status in the year of 2025? Do you still think it's a security? Just help me understand what happened there.
I would argue that like, what's the designation matter, right? Like the designation only matters because like you want people to be protected in an ecosystem that allows them to trade fair and orderly, and that their assets are custodied to the gold standard such that their assets are properly protected. Right. And if we look at sort of the custodians in the state licensed custodians, right, on the crypto side, right, there's an argument. What happens if one of these platforms go bankrupt? Do you become a general creditor?
I don't think you gave me a yes or a no on whether you think Ethereum is a security or not.
For me, we've had our analysis. We've said what we said previously, but I honestly think it's just a question of being treated and traded in an environment that allows for investors to be properly protected. Whether it's a security or not, like, again, like this is an argument that I think is focused on by certain elements within the industry, because it becomes a question of how do we stay outside of a higher regulatory burden, right?
Interesting. Okay.
So like if it's traded here in one universe and it's traded here in another universe, that's just for the investor to choose.
Sure.
Like,
Okay. No, I understand what you're saying, but I think this whole idea of like whether a cryptocurrency is a commodity versus a security is still like pretty core to like your business, right?
I mean, maybe, but like if you look at the FAQs that were put out recently, there was a strong argument that could be made that custodians, special that securities licensed custodians can custody non-securities digital assets.
Got
That
it.
was in the FAQs put out by Commissioner Peirce recently.
Sure. No, I totally, I just felt like that was one of those things where it's like, this new sort of regime comes in, this more crypto friendly regime that's more interested in like collaboration versus enforcement action. And it really did feel like this whole idea that like what you guys were building towards, like, it felt like from an objective standpoint, it felt like it was a setback to sort of the goals that you guys sort of had. And now you guys are sort of building in this direction of tokenization, and like this question of like whether or not something is a security or a commodity or not is, I guess what you're saying is it's not relevant, because at the end of the day, like we want to service the full life cycle of an on-chain security.
Yeah, I mean, like the other thing is like it just comes down to like multiple fold. A, how do you get access to the tens of millions of brokerage accounts that are out there, right?
Mm-hmm.
How do you allow the brokerage industry to compete in the space? A, and B, from an investor standpoint, let them choose,
Mm-hmm.
right? Like if they want to trade on a crypto exchange and there's certain protections there, there's one way. If they want to trade on a securities licensed infrastructure, like particularly on the custodial side, it's a different way. And like the point before is that on the custodial side, the question becomes if you're not following certain, like I would make an argument that like the banking and securities laws in terms of custodial on the federal level are the gold standard. They're
Mm-hmm.
the hardest ones to get, right? There's very few securities licensed custodians for digital assets, and I guess is there one digital bank? There's one digital bank, so like
Mm-hmm.
essentially like those are very high standards to get,
Mm-hmm.
right? And part of it, those rules require you to segregate your customers' assets from that of the institution, right? And why is that relevant? Because if like let's say the platform goes bankrupt, right? Let's say it goes out of business. In a securities context, those assets are yours. They're segregated, right? Basically there's protections to make sure that that's not happened, right?
Mm-hmm.
On the state licensed crypto custodian side, I don't think there are. I think that it's been proven you become a general creditor, meaning you have to get in line in the bankruptcy. Your assets aren't segregated. So like from that standpoint, it's just a question of what people want and the protections they want. And I think it's not like in terms of like the SEC, it's more of a like obviously it's a paradigm shift. I think it's wonderful because it means that major institutions are more comfortable participating in the space, issuing securities on chain.
Mm-hmm.
But beyond that, like I don't think it's necessarily a prohibitive mindset. It's a question of letting people make the choices, informed choices, right? So like there's the element of like, there was the decisions about certain meme coins not being securities, and that's caveat emptor, buyer beware, right? And the idea here is we're in a business environment. Business is good, and I totally agree with that. Right? So like essentially like it'd be great if there's different platforms with different standards, and then it just becomes a question of like A, where investors to choose, and B, like that's just more on like the individual investor standpoint, but B, like what will institutions choose?
Yeah, and I think it's a huge. I think the idea of institution versus retail is like very much two different worlds in the crypto world today, right? The activity that you see like retail traders engaging in versus what institutions are engaging in. There might be a surprising amount of overlap there, honestly, but at the same time, like kind of it's apples to oranges in some levels. And, when we talk about this idea of like Prometheum as a business, and like the idea, like you guys definitely are one to cater towards institutions, like no doubt about it. I think like one of the things I would be curious to get your take on is like what would need to happen in order for Prometheum to turn into like this flourishing business? Like because it does seem like we are approaching this like the point where it's like issuing tokenized securities that are natively tokenized could become more commonplace. But I'm curious, like, is there anything that you feel like you need as a business in order to actually like get going and flourish?
So, Andre, a couple of things there. First, I think just a clarification on the nomenclature, right?
Yeah,
In terms of like using tokenization, I'm not sure is the right term there, because tokenization is a representation of an underlying that's already been issued, right? That then is
native
represented on chain.
tokenization.
Well,
Okay.
or what we would say is like on-chain securities. You
Man,
see what I'm saying?
okay. Yeah,
I
no, I
get it,
see what
but
you're
even the
saying.
regulators,
Everybody's using different terms here, so
yeah,
I
it's
hope you can
like
bear with me.
no, I don't mind. I'm just hoping, like, I'm just trying to clarify for the audience and potentially. So, like, in terms of like securities moving on chain, we've been working with issuers for a long time, and we're very excited for more and more products to come on chain. It just becomes a question of like it comes down to the point I made before about just what are the costs? Why are people going to use a technology unless A, they can save money, or B, they can make more money by putting that asset on chain? Right? They're a little bit different. One is saving money that, those cost savings are passed on to investors, or maybe the institutions in theory could, generate more revenue from it, right? The other is basically the idea of being able to use a natively issued asset in a sort of collateral manner such that you can get additional yield off your capital or stuff like that, right?
Do you think that's like where the tokenization space is going? Because I kind of like when I talk to people, like that's what they get really excited about. Like like this idea that you could actually like earn yield off of assets that are like tokenized or use them in lending or sort of like arrangements that you just can't do in traditional finance.
Right. And I think that's what will happen with on-chain issuance.
On-chain
But with
issuance.
tokenization, I think that's more of a stretch
Okay.
because like the actual it particular listen, let's clarify different types of tokenization here,
Yeah.
right? So synthetic tokenization, right? That's a I don't I, that's very risky there in my mind in terms of if you're going to be using those tokenized assets that don't actually represent ownership in anything and using that for collateral in a decentralized capacity and in a DeFi capacity. How does that make sense? You don't actually own the share, right? And like, we've seen that could lead to a lot of issues, right? And I think that becomes more of a house of cards type thing. I don't know if you want to compare it to like remember the black box yield that used to happen with Celsius and the like, right? But like it's dislocated, right? There's a dislocation between reality there because you don't actually own the asset and the potential ability to use it in a DeFi sense where what does it represent?
So you're saying if we don't do tokenization right, it essentially creates a house of cards out of DeFi.
It's easy for things to proceed in an orderly market,
Yeah.
right? Like when things are good, man. Like, it's not, pay attention to like nuisances, right? But, or realities maybe. But like when you start to deal with a disorderly market, particularly one that has sort of dislocations or, between ownership and between prices and between markets, it leads to a potential more, it actually leads to probably more risk being introduced to the system, which will lead to more precipitous, downfall and a larger black swan event,
Mm-hmm. Mm-hmm.
right? And I think like it becomes this is sort of the like what's investment and what is gambling, right? Like
I was not expecting such a philosophical take. Like when it comes to like this idea of like securities moving on chain, like at the end of the day, like we can have like what you're saying is like we can have a market or we can have gambling, which is like something that is like really like not obvious on its face.
look at what the in the industry, like you had different sort of like boom and bust cycles, right? Now there was the ICO cycle, which you can make an argument like what were these assets being issued? That's irrelevant here. These were supposed to be substantive products, right? Where basically there was token alchemy. Basically, as the blockchain developed, more activity occurs on the chain. There's some sort of like fundamental attachment to value. Now, like there was a lot of speculation in that industry. Like a lot of Bitcoin millionaires were created, and people were chasing that dragon, right? But like at the same time, like that was more substantive. But then you have NFTs, right? And I think NFTs was a boom and bust cycle where there was a lot of bad taste left in investors' mouths.
Wait, you're telling me bored apes don't have fundamentals?
I mean, honestly, the only NFT I considered, and not my thing, was the Harambe NFT. Long live Harambe, essentially. But Yeah, I don't know if it's fundamentals, but I think it was just a way to potentially get more activity through a different form of speculation, right? And it's sort of like each time this cycle sort of moved along, there was a less integrity to it, maybe,
Mhm.
because like after that, what's the next boom and bust? You want to say it's meme coins, right? And
Yeah,
meme
that's
coins
such
are
a
just,
hard one,
but
right?
meme coins make sense in some sense. It's just a assetification. Like it's a way to create an asset that literally just represents speculation, right? It's just it encapsulates a trend, right? There, I don't think there is necessarily fundamentals to that, right? So that's transitioning more towards gambling in that sense. And now, like the lessons that, like, everyone, something works a couple times, people like do well off it in terms of like platforms. The question is, how do we find this next, shiny toy to do the same thing with? Now,
Hmm.
like these were new instruments, right? In the sense that I don't think anything like meme coins had existed for a long time. Like maybe tulips at one point, but like, the question that becomes is like, okay, so there's been experience with that. There could be revenues generated for this. How do we now take these concepts that have been learned and apply that to securities, right? And like the ability to do that from like to take equities and to create synthetic markets off that I think might be a bridge too far. And the it's this brings up another super interesting point in that, like, is that the transition then from what you have as an investment and turning it into a gamble, right? And like in the meantime, we saw other things develop too, which were gambling based. You had basically prediction or augur markets, right? Which I think they actually serve a real purpose in society and are an excellent indicator of how people actually feel of sentiment. But like we live in a society since the crypto started and started getting popular, let's say in 2012, right? We've seen the emergence of DraftKings. We've seen the emergence of lots of betting platforms, and basically, like, who knows how that will create potential issues for the younger generations going forward. Like, I sound like such an old man, but but essentially, like are we living in, like, that's okay because that's gambling, right? That's like sheer risk. That there is no fundamental. Maybe you have some knowledge about the players or something. I don't know. But like to take these concepts and to sort of extrapolate them to like the actual securities markets where investment decisions are supposed to be based on like full disclosure, on understanding all material facts in terms of making an investment decision. I don't know if it works. Now,
Mm.
like, and I'm sorry, I'm going on a long time here, but like in regards to like this brings to the final point of like these all-in-one investment platforms, right? And like what you started the conversation with, in that, like we said, it was ironic that certain platforms that would argue we're not securities, we don't want to be securities, we want anything to do that, right? Lack of regulatory clarity, which you could sort of make an argument helped out the crypto industry more than the brokerage industry, right? Now that they've grown to critical mass, they say, oh, the securities industry generates a lot of revenues. Let's go buy broker dealers. Let's go try to do securities activities, right? I mean, I don't know if you see Ondo when, acquired, what was it, Oasis's Pros, ATS, or whatever they had there, right? You have different platforms looking to go into the space, whether that's on the securities and also the banking side, right? Let's let's not forget, like the original thought was like, we don't need the banks. The banks are evil, but now they're all trying to become banks. We don't need securities. Securities are evil. Now they're all trying to acquire broker dealers, right? It's sort of like come full circle now. Now, maybe that's part of like a maturity in any sort of industry,
Hmm.
but I'm not sure a lot of the practices and mentalities that were attendant to these, not security type practices can now be, Trojan horsed into the securities markets.
That is a beautiful way of putting it. And I feel like that really just encapsulates the conversation we've been having for the past like 45 minutes and really like brings it over to the succinct point, which is like, you know, these sort of practices have been perfected in the crypto space that are outside of securities laws. And you're really saying that, like, hey, they're going to have a hard time taking these practices developed around meme coins, developed around NFTs, developed around ICOs that the industry has gotten very good at. They're going to have trouble if they think that they can just play those same games with securities now that, as you mentioned, they reach critical mass. That's awesome, Aaron. Anything else that you feel like you want to add on this topic? I really appreciate you taking time out of your day in order to talk to me. I know you have a wealth of knowledge when it comes to securities laws. Talking to experts like you is really important in terms of trying to wrap your brain around something like this.
And listen, I think this is all productive conversation. I think like what's great is that in regards to like the speed at which things are moving, right? Like, you saw announcements about tokenization outside the United States with OpenAI and SpaceX, right? And you see a proactive, agile SEC coming out with comments with that within a couple of weeks, right? And like that's beautiful, man. Because like instead of like letting something become a problem such that like how do we deal with this now, right? Which was arguably what happened with ICO booms, right? like proactive, interactive regulators are productive, are useful for everyone. They make everyone feel more comfortable. They're better for America because they create a business environment where, American capital markets can continue to improve and flourish instead of like continuously worrying about like, if I do this or if I do that, am I going to get a letter, right? Like, and like, while people in theory who are doing things wrong should get a letter, they shouldn't be afraid of if I make a change, do I get a letter, right? So all of this is actually a representation of productive regulation, productive regulators, and an industry moving forward. So I guess, this is wonderful.
Well, thanks, Aaron. I really appreciate it. And that'll be it for us today. As always, go to Decrypt Media to get all of your crypto news. I'm André Beganski. This was Aaron Kaplan. Thanks again, and see you in the next one.